In our discussion last week with Davis Garrison III from Preservation Financial, we learned that an index fund tracks the market index and is usually made up of stocks and bonds. And today, Davis is back to tell us why index funds might be a wise choice if you're worried about a downturn in the market. Good morning, Davis.
Good morning, Chris. How are you?
I'm doing well. Let's pick up that discussion again about index funds. You got some more information for us.
Yes, sir, I do. We had discussed them in a broad means last week, but I thought I came across some good articles, and I thought that it might be apropos to mention them again. And some funds are riskier than others, but these three choices that I've got for you today are among the safest during times of uncertainty. And we are in a very uncertain time right now. The first one is S&P 500 index funds. They mirror the S&P 500 index, which I consider the most viable broad barometer, for the markets. 500 of the largest companies in the U.S. and the S&P 500 is volatile. If you look at GE, which was the first company in the United States ever admitted to the S&P 500 index, that's great. GE is a wonderful company, been around forever, but last year GE was bumped out of the S&P 500 by Walgreens. But behemoths like General Electric, they're going to be around. They have the ability to continue reinventing themselves. They have a lot of oars in the water, as I like to say. But the next group of stocks in the index fund category is the total stock market index funds, and they are similar to the S&P 500 index, but they include groups of stocks, indices like the Russell 3000 index, the Wilshire 500 total market index, which contain thousands of diverse companies, and they're considered benchmarks of what the entire U.S. stock market is. There's also bond index funds, which are the other side of stocks. Bond index funds can be quite volatile. There's like the Barclays Capital U.S. Aggregate Bond Index. It measures the performance of U.S. traded and foreign bonds. In general, bonds tend to be less risky than stocks, but bonds carry different risks with them. They are less risky, but they are sensitive to interest rates. And what we've seen in the past, in the last few months, the Federal Reserve has stepped in to try to put the skids on the economy going down the tubes. And what they've done is dropped interest rates to an all-time low. We're barely 0.5% on the 10-year Treasury bond right now, and that is a new record. One thing I wanted to mention today was that we got a jobless claims report out this morning, first thing.
Right.
963,000 new people filed for unemployment, and that's under what we were expecting. So that's, if you want to treat it as good news, that's good news.
Is the stock market reacting to that news today?
The market is down overall. The S&P 500 is a shade up. The NASDAQ 100 is a shade up, but the Dow reacted negatively to that as last I saw.
We have basically been in a recession since February, and I was going to ask you, one thing that kind of jumped out to me from the notes that you sent me is the fact that we can be in a recession and not have a downturn in the market.
That's correct. And all the recessions that we've had, and we've had 27 recessions since 1900. I've talked about this before. They average on average, they happen every 5 to 7 years. So we've talked a lot about the last 11 years, almost 12 years, that was the longest running bull market in history. But it is not necessary for a recession to create a down market. It's just a relative figure.
And when you were talking about the total stock market index funds just a moment ago, I think one thing I found fascinating there is even though you may lose a little in the short term, you're going to gain it back when they recover, and they've always recovered after some downturns.
Exactly, and historically, and that's all we've got to go on. We can't look forward and anticipate anything looking forward, but historically, index funds have always been your best bang for the buck if you want to maintain a positive outlook on the market.
And folks, if they're wanting to they're starting the planning, they're in the middle of planning, or whatever area of life they're in right now, they need to contact you, get some information before they make decisions like this about whether or not to get into index funds, correctly?
By all means, yes. Just contact us, shoot us an email, give us a call, whatever, and we will, we've got everything at our disposal to pretty much guide a path.
All right. Davis, thanks so much for taking some time with us today. I always enjoy these talks. I learn something every time I talk with you, and I know the folks will too if they give you a call.
That's great, Chris. Thank you very much.
All right. Davis Garrison III from Preservation Financial. We got all the information. If you need to contact him, we got the information for you right there on the screen.
The preceding portion of Daytime Tri-Cities was sponsored by